Hello, everyone. We see you've got quite a full room, so that's quite exciting. I think there's still the last people coming in, but I think I'd like to start with everyone here being present and online. Irene, just to let you know, you're like on the big screen behind us, so you're really part of the panel. And I see you laughing. I had to look backwards, but that's good to see. Okay,
Nice
welcome everyone in the FinTech session on open innovation, a collaborative model for financial service providers and FinTechs. Before I introduce the panel or let the panel introduce themselves, let me just a quick word about myself as moderator and kind of the objective of this panel before we go into that full force. So I'm Anouk Verheijen. I work for the Dutch Development Bank, FMO. And as many of you know, FMO has been a long time supporter of the financial, of microfinance sector and of the team of financial inclusion specifically. So back in the day, I think in the early 2000s, we've been providing quite a bit of support to greenfield MFIs and now through our debt and equity investments, we invest in numerous of a portfolio of microfinance institutions. And then also through our ventures program that was launched a couple of years ago, we also invest in fintech and funds that do invest in fintech. The same applies for microfinance institutions as well. But yeah, next to investing, FMO also has got a kind of an increasing part of our business that is focusing on technical assistance, where we provide technical assistance support to our client directly. And that's actually the division that I work in. And in that capacity as a senior programmatic technical assistance officer, I oversee some of the technical assistance programs that accompany our investment programs. So one of them, for instance, is Nazira, which is a financial inclusion program, which is providing second loss risk sharing to financial institutions to really move them to kind of the harder to serve segments, like youth entrepreneurs, women entrepreneurs, but also refugees. So that's a little bit of my background, and I started with FMO last year, and before that I worked as a consultant, and I started my career at a small consultancy firm called Tweeders Facet. And I remember kind of starting there. This was way back in 2007, so we had to dig a little bit. And we had like a DFS practice, and it was digital financial services, which is interesting, kind of a topic that was already on the agenda back then, and it's still now. So I think that tells you something, and that brings us also to the topic of this session, where we're looking at partnerships between fintechs and financial service providers, but also and looking at the kind of in a broad scope, so not only loans, but also, for instance, insurance products. And I think, given that we are still talking about this topic kind of more than 15 years later, kind of as an illustration of that, it's probably not as easy as it seems. But I'd like to hear more of that, about that from the panelists that I'm joined by. So I'd like to just do a quick round of introductions. So if all of you sitting in the room, if you can just quickly mention your name, the organization you work for, and kind of the type of partnerships you are mainly involved in. Damien, do you want to start?
Sure. Thank you. Hi, everyone. My name is Damien. I'm one of the co-founders of Rubyx, which is a global fintech operating as a lending as a service platform. What we do is that we help MFIs and banks to better use the data for automating some of the processes, also improve risk management and start launch new innovative credit products. Something that we do as well, and part of our mission is to help them acquire new loan portfolio by facilitating partnership with what we call digital platforms, or think about e-commerce, solution payment, gig platform, whatever. Company that is generating some transactional data that we can use for doing some risk analysis and start a lending activity with them.
Thank you. Maria, do you want to carry on?
Yep. So I'm Maria Mateo, one of the co-founders and the CEO at IBISA. We are a global climate insurtech, and basically we are headquartered in Luxembourg, but we have presence in Asia and Africa, like India, Philippines, Senegal, Ghana, a bit in Kenya. And what we do is we work from understanding the needs, insurance product design, structuring, pricing, operations. So in these activities, we partner with two types of FSPs. One is with the insurance industry. So insurers in each country are our partners, and this partnership is vital for us, it's critical. And on the other hand, we have launched a product for financial institutions to help the lender and the borrower to mitigate climate risk through an innovative insurance product that we will tell a bit more later.
Thanks, Maria. Faisal, you're already taking the lead. That's good.
Thank you. My name is Faisal AbdulWahab from PCES. PCES being Process Crafting and Expert Services. We are an IT consulting and software development company. We provide payment platforms for fintechs, and on the other side for financial institutions, we provide technologies such as digital channels for providing services to their customers. So in a way, I've worked with both sides, one providing platforms for fintechs, and on the other side, providing digital channel services to financial institutions.
Thanks, Faisal. Jacques, I could
Thank
just
you.
see you. Carry on.
Yeah, thank you. So my name is Jacques Ngoma. I'm CEO for Microloan Foundation, Zambia. Microloan is a licensed financial institution, microfinance institution. We are currently second largest on the market in terms of beneficiaries. But if you look at us as a financial institution with a single mission of reaching to women, then in that particular lens, we are the largest on the market that are 100% focused on financial inclusion for women. We have a number of fintech partnerships in the country. This includes partnerships we have on disbursements of loan on digital platform, collections, allowing clients to also do statements and other things that we have. But for this particular discussion, my focus is really going to be to highlight some of the work that we are doing in building a new savings mobilization platform for women that is mobile money based, and some of the experiences we have had on that journey. Thank you.
Thanks, Jack. And then last but not least, Irene. Oh. I can't really see.
Hi, everyone.
There you are. Okay, great. Carry on.
Can you hear me?
Yes, I can.
Okay, great. My name is Irene Mutonyi. I'm Chief of Staff at APA Insurance. We are among the leading insurers in Kenya, underwriting general health, business, and also asset management. In this particular context, I will be talking about the programs that we have towards farmers in Kenya. We have two main programs. One is the Area Yield Index program that targets crop farmers, and the other one is a livestock insurance cover that targets herders who are typically at the bottom of the pyramid. And we pride in being able to partner with fintechs. I'd like to say fintechs, insurtechs in their technology, and I'll talk a little more about that as we go on in the discussion. just basically just ensuring that we can get technical expertise, for example, yield measurement, soil testing, collection of premiums from what would otherwise be a really difficult task because you're dealing with volumes of transactions and at micro level. So it's been really beneficial to have to partner with fintechs stroke insurtech.
Yeah. Thanks, Irene. Jacques, I would like to start with you first. Given as a microfinance institution, you were saying you've been involved in a numerous partnerships with fintech. Maybe just before kind of zooming in specific partnerships, what do you think, like when is a partnership with a fintech appropriate for you as a MFI? And also what conditions need to be met as an absolute minimum to set up a fruitful partnership? I'm looking forward to your reflections on that.
Well, thank you. I think to answer the first part, when are the partnerships appropriate? I think that this question really depends on each different type of MFI and what the interests at a particular time are. But for Microloan Foundation, we've seen at various stages of our development, different kind of needs that have made partnerships very appropriate. We started our first journey around about 2017. And around that time, I think the major issue we were looking at was how do we improve efficiencies in our operation? And we used to be one of the traditional MFIs carrying loads of cash, moving around different villages, delivering the money and having clients to pay, which you can imagine is not very efficient. The first partnership we signed on was a fintech company that enabled us to move away the cash payments into more digital platforms. And so as we speak today, all our loan disbursement are 100% done on digital platforms. And we're also collecting using the same platform, even in very, very rural areas. And that change alone has enabled us to reach such a wider market. I mentioned earlier that now we stand as the second largest. I think that transition would not have been possible if we did not identify the right fintechs to work with. So there's an element of efficiency improvement. But I
Can quickly interrupt because I'm intrigued with what you're saying, the right fintech. So yeah, what are the right fintechs?
Yeah, so the right fintechs, again, I think that was going to be in my next response because it really has to do with mission alignment. And I want to really believe that it's very, very critical that you find a fintech partner who's like-minded, who is serving a similar mission like you do, because along the way, it's very easy for partners to disagree or to begin to pursue different objectives. And that can be a risk to a microfinance institution. One of the early partners we joined was very clear that they had a focus for rural areas. And when we joined with them, it was very clear that we were all really in the same mission, and we could agree on things that I will also try and elaborate on further: pricing, customer journey, and other things like that. So I think for me, the right partner is one that aligns well with the mission and vision of your microfinance institution, which is what the Microloan Foundation has found to be useful.
Yeah. Damien, quite interesting kind of you coming from from the fintech side. What are your reflections on that? What Jacques just said?
Yeah, so I think you can see fintech partnership from two lenses. There is the technology part and then the financial business part. So on the technology side, a good analogy, I think, is just to think about what a fintech can provide, something similar to what the cloud provider can provide to you. So you can run your own server, you can invest in equipment, you can hire staff for maintenance and that kind of things. But it's not necessarily the most strategic move to do. On the other hand, you have those cloud providers that provide at low cost the top state-of-the-art equipment with access to high-skilled staff that can help you in support and maintenance, and have those nice services built on top of the data warehouse. So on the tech part is exactly what a fintech is providing to you. So this kind of low-cost access, because you pay only for what you use, to top-notch technology. Then you have, I think, more importantly, the business side of the collaboration. And from that point of view, you can see a partnership with a fintech as a shortcut to innovation. So basically, the same idea for technology. You don't have to invest in an innovation team and everything to test a new idea. You can come to a fintech that has a specific business case that you want to try, and start with their own experience. And it will be much faster because they have implemented this project in many different contexts for various different players, while for the MFI, it would be most probably the first time. But to be successful, of course, you need to start with this business case that we were discussing. So you need an identified pain point. So you shouldn't start a partnership for just opportunistic reason because there is some funding opportunity available to you. It can work, but it's not the most fruitful partnership that will come out of this. And also, you need to make sure that there is no big major barrier to the implementation of your solution. For instance, like regulation that could impose some manual processes into the automation that you want to implement, and so would break completely the idea of the innovation.
Thanks, Damien. Moving to Faisal, I know, for instance, in Congo, you've been involved in what I would call a tripartite partnership, making things more complicated. Maybe you can quickly explain kind of what the partnership entailed, but also having heard both the fintech side and the MFI side, what are the key kind of conditions that need to be met to kind of bring the three parties together? When does it make sense, in other words?
Yeah. So I would take the question in a more technical direction. So beside the,
as long as we can still follow you, I'm fine.
Yeah.
But I'll interrupt.
So as long as the mission and vision that I would leave to the business people to see that there is that alignment on that side. But on the technology side, there is always the temptation from financial institutions that you want to do it by yourself. But financial institutions are not technology companies. So there is mostly that gap. If you want to go fast with the kind of products that you want to offer as digital products, that you have, the possibility that you don't go as fast as your competitors because you're a financial institution, and therefore technology is not at the forefront of what you do. However, on the fintech side, technology is what they are meant to do, and they are faster and more innovative. In the case of DRC, what we had was that we had a financial institution that wanted to be able to do disbursement and transactions with mobile money operators who have digital wallets. So you have 4 mobile operators in the market. From the financial institution perspective, you could decide to do an integration to each of them to be able to offer the service. But it means you do 4 integrations, means you run 4 projects. The possibility of going faster, running 4 projects, it's much less. Compared to integrating to a fintech, which is already integrated to these mobile wallets, you do 1 integration to the fintech, and you immediately have access to all the 4 mobile operators. So in this case, it makes sense to go with a fintech where you do an integration, you run 1 project, and you have access to all the mobile operators and all the wallet platforms in the market, rather than having to do an individual one. So from the technology perspective, it makes absolute sense if you want to have the innovation and to move faster with the digital products that you have, to partner with a fintech to provide you those services.
So moving faster, but also reaching scale faster, then, if I'm summarizing it correctly.
Exactly.
Okay.
Exactly.
Maria, you're operating in a slightly different space in the sense that you really have a clear focus on insurances, but also being a insurtech. Hearing Damien's contribution, kind of does that apply also if kind of for partnership between an insurtech and a MFI?
So, I mean, I share a lot of what it has been said already, that it needs to come with a shared vision. For us, this comes more naturally partnering with insurers. I think with MFI, it's more still on the awareness part. Like now we launched a bit ago this product with MFIs, and we, like from the MFIs associations and all that, we know that the third largest risk for a loan portfolio of an MFI is climate. Like this, the MFIs know. The issue is that they don't have history on loan default. They don't have automation in how to do it. And because of that, they cannot quantify, what is their dollar exposure to climate. Like they know this is very important, but I cannot quantify it. So us as partner, like if I were just an insurer, let's say selling insurance, I would say, here is my insurance product. But here is where the partnership comes. We have to handhold them, let's say, to analyze with them their portfolio, say, okay, this is your climate exposure, and then together build a product that will help them minimizing this exposure. And if this exposure is minimized, there is the benefit that they can disburse more loans, that they will get less default, or because if there is a borrower protection, the borrower will be able to pay, so they will have better scoring. So there is like a virtual cycle to have that, but they need a lot of hand-holding. While in the insurance space, our way of partnering is much more coming more natural. In the MFI space, is like, yes, we have the shared vision. We know climate is top 3, but we don't know how to act. So there is a lot of hand-holding, and a successful partnership comes when the leadership of the financial institution acknowledge this and say, I want to tackle this problem. I want to put the people, the resource to work with you hand in hand and see what is the outcome. So we have like the two sides of the coin with the two type of FSPs, insurer, MFIs. And while the insurance partnership for us is more natural, mature, the MFI is more a hand-holding. And unless they really say, we want to do this, it's on our priority, we are putting the resource, we don't move.
Yeah. So it sounds like your partnerships with MFIs, you're still like newlyweds, kind of just married, but you still have to get to know each other.
Yeah.
Kind of, if you look back and I think you have been working with MFIs now for 2 years, if I'm not mistaken, kind of what were your main surprises or kind of like steep learning curves in that regard?
So in India is where we have most experience for this particular product. And in India, there are different categories. There is the NBFCs, non-banking financial companies, then the MFIs, and then all that. So I think, some of the surprise is to go to tech MFIs or tech NBFCs and see that they have no clue on what is their default rate.
You were expecting that they would have that, I assume.
I would expect.
Yeah.
So starting from this basic thing, like tech MFIs does disburse digitally, and they don't know their default rates. So of course that makes our work a lot more difficult, because it's more difficult for us to prove that they have a climate risk, because what we will do is correlate these defaults with climate events.
Yeah.
So not knowing their default rates, it's bad starting. But then it's a bit the same, you know, because these MFIs also want to grow aggressively. Sometimes they don't have a lot of risk management in place. So they disburse on demand and they are not assessing the risk on their portfolio. So this is also something we learned. So now we, let's say, go to not that techie fintechs or MFIs. We go to the ones that are more years established on the market and that have more data.
Okay.
So at the beginning, we thought we will be more like-minded with the newest, more techie MFIs. And after this time, we learned that probably the other way for now is better.
Okay, no, interesting. I wanted to ask something to Irene, but you're not on our screen below. Is she still there?
I'm here.
Oh, you're still there. Good.
Yep.
Having heard that Maria saying she kind of to really launch insurance products to microfinance institutions, she is providing a lot of hand-holding. Do you see as an insurer, do you see the value of SureTechs in the landscape, and how do you view that? Yeah, as an insurer, good to hear your opinion on that.
Yeah, interesting that technology has been a challenge on our side. We had actually highlighted the top benefit that we've seen with InsurTechs is the innovation, because they bring with them technology. And I want to give an example of the pastoralist cover that we give. This is end-to-end. End-to-end, you have very little human intervention. So it is all, we measure, the onboarding is through the mobile phone, in partnership with Safaricom, one of our telecom providers who serves as a fintech. And then we've got the forage that's measured by satellite. And for that, we need an insurtech who can bring the technology in. So end to end, and then even the claims are paid via mobile. So it saves a lot of time. And just talking to the team on the ground, you know, we started this program in 2010. And Safaricom then came in with the mobile platform, payment platform in 2017. And what a significant difference in the efficiency, even reconciliation, and even tracking of your activities. And I think and at another level, and another value add is the research-driven decisions, because now we can see what the customers, what kind of trends we are recording, and you can make more data-driven decisions rather than trying to measure estimate the climatic conditions. So that's been really good. I know. In addition to, aside from technology, we've also had a great advantage in the reach, because as a traditional insurer, it would be otherwise very difficult to reach some remote areas of Kenya. And what we find is that in the informal market, which I'm sure a number of insurers can relate to, from our developing countries, the insurance is basically viewed as, there's still an element of a blue ocean that needs to, of the informal market that needs to be reached. And so you find that insurtechs already have relationships with these farmers, and they're able to help you reach where you wouldn't otherwise have reached, and you can actually expand your business that way. So we pride, for example, in having reached 1.4 million farmers since the inception of this program, and this would otherwise not be possible except the technology has enabled it.
No, that's interesting to hear. What I hear a lot, I think there's a clear business case to go into, and I think one of the key, something that was mentioned by all of you, is that you need to have an alignment as partners, which I suppose, yeah, I think for any partnership does apply, but is still a key prerequisite. Going a little bit more in the kind of nitty gritty. Maybe Damien, would you, if you really, look at kind of when you implement kind of a partnership together, what are kind of really key parameters to make it into a success?
Yes, thank you. So I think if we want to summarize this, I would say that you need like a buy-in for commitment, as we just discussed, the business case and everything. Then we need trust and incentives for adoption, and finally you need some capabilities and resources for implementation. So on the trust and incentives, so it's not only about having trust between the institution and the fintech, it's also having trust with the end user. So it could be loan officer, it could be the borrowers itself, if the solution will be for them. So it means getting them involved in co-designing the solution. So it's quite important to do so that you make sure that the actual user of the solution are involved in the implementation. And then on the capabilities and resources, of course, you need some dedicated staff to run the project. It's not always the case because it's often considered as kind of the innovation side project, and so nobody really cares, and so it takes time to move forward. And in terms of capabilities, I think what is interesting is that a partnership with a fintech would potentially reveal some of the weaknesses existing into the institution. So it's not because you are working with a very advanced fintech company that suddenly all the limitation you have in-house will disappear. So if we take a concrete example, if you have bad data quality, it will still be the same after a partnership with the fintech. But on the good side, on the other hand, if it's a good opportunity to take this innovation project to tackle those issues. So I would say that at Rubyx, when we run projects with MFIs, half of the time is spent to solve those kind of issues, and we have the experience because we do that often, and so it can also help bring some value on that side, not only for the ultimate innovation that you are working on, but also on all the value chain that is needed to achieve the output.
Yeah. Going to Jacques again, the other side of the table. Kind of interesting observations that you made. I think often a lot of partnerships kind of projects move slowly because it's kind of it's one of the projects that you run within an organization, and it's innovation. So it's not kind of core business. There's not enough resources available. And then obviously, kind of along the journey, you kind of, there's some hidden problems that come to the service. What is your experience with that? Can you disclose some of your hidden problems, or is this a too far reach? But we would be interesting to kind of learn from your experience.
Well, thank you. Yeah, I think we have a lot of experience in that regard, and one particular experience is on one of our projects that we're working on with one partner on building a mobile money-based saving solution to allow those in rural communities to save where the banks cannot reach them. One of our challenges we've found from my experience is that partnerships sometimes can also be very, very rigid. I think it's been discussed that it's a easy way to immediately deliver, but we also notice that in other cases it can be the longer way, because when you begin to negotiate and discuss these particular solutions, you can also find partnerships that are very rigid in delivering to you what they maybe have delivered in other scenarios without giving the particular case that you're looking at the attention that it needs. And we have gone through this journey so many times, and I think one of the interesting, case I wanted to actually share here was we ended up not being able to meet the goal, and that partnership was not successful. We had the partnership for 2 years, and because we couldn't really move the partner to meet expectations on our end, and they had a system, they said, look, this is what we can give you. And then they mostly were thinking that an MFI like ourselves needed to do all the adjustments to fit what the fintech solution would be. So I think those are the kind of issues that are there, and it can be very hard sometimes to find a partner who's flexible and who's willing to also adjust the needs according to the expectations that you have as an institution. Yeah, I think that's my contribution.
Yeah, no, interesting reflections. Faisal, do you recognize that rigidity that kind of Jack was mentioning? I think you were nodding, so it was interesting to hear your reflections from the field.
Yes. So mostly it all boils down to the cost of the project in the end, right? So if you're working with a fintech that things that, you know, they need to maximize on the fees that they get from the financial institution, then there is really the likelihood that they would want to give you an out-of-the-box solution, as we call it, something that is already implemented somewhere else, and they will try to fit that into this financial institution. And as you rightly said, in most cases, every financial institution is different. So you need to be able to define a product together with them in order for you to be able to satisfy your clients. The other thing is that in order to make the partnership successful, in the end, you need to be able to provide financial services at not a very expensive financial service in the end. So as much as you want to innovate with technology, with the fintech, on the other side, you have to also look at the pricing that you are agreeing with them. We've seen partnership where they've started very successfully. When the transactions begin to grow and customers begin to use the service, the charge for the service is just too expensive that the partnership, you know, has to end at a particular point, because you are not able to remain competitive in the market because the cost of the transaction is just too high, because fintech wants to take a revenue, and on the financial institution side as well, you also want to make a revenue out of it. And in the end, the customer needs to bear that cost. So mostly the advice we give to financial institutions is that when you are negotiating the contract, especially with regards to the pricing, it's always better to have someone who understands technology in the discussion, so that when the technology jargons are used, you know, you understand exactly what it means, that when the service is being provided, you don't realize in the end that the service is simply too expensive to maintain. And
I'm actually interested in what you're saying. It's kind of often, especially when you start kind of a partnership, obviously you want to introduce something, and at the beginning you're doing it at a small scale with the aim to scale up, where kind of it becomes kind of more attractive price-wise. So how, like in practice, how have you overcome, like, have you come up with kind of innovative pricing structures to make sure that even at the kind of start of a pilot, that it doesn't the services or the digital projects that you providing to your kind of initial set of clients in the pilot is still affordable? How have you met it? Yeah.
So I would give one example for a project that we run in the DRC, and it was providing financial services using USSD channel, because they wanted to reach customers who didn't have internet connection and so on. So the product started first with being able to do fund transfers and so on. And for such transactions, the bank was taking a fee, so it was okay to do a revenue sharing with the fintech. But at a particular point in time, they realized that, okay, on that channel, we want to add services that are not transactional. So someone wants to check the balance and so on. But the contract they had with the fintech was that for every request that is made, you need to pay. Now you are adding a service that is an inquiry from the financial institution's perspective, they don't make any money from it. So the cost towards the fintech increases tremendously because end of month, people are checking to see whether salaries have been paid. And then the financial institution ends up having a huge bill because a customer is checking 5 times just to check if the salary is paid at some point without really making a transaction.
Expensive way of checking your salary, indeed.
Exactly. So for that particular contract, what then happened is that the moment where the discussion on the pricing was taking place, the fintech was saying, okay, we charge per transaction. But then what the financial institution should have gone for is to charge per session, not per transaction, right? So in the end, they would have reduced the costs, of having not to pay the fintech if it's not really a transaction. And of course, if the fintech sees that you give volumes, they are always open to go into that discussion because they wouldn't want to lose the FI and would not be getting the revenue that they would have had otherwise. And then the last point to also add is that in as much as possible that the fintech would bring you innovation, internally, the institution should also see that they have an end-to-end process that is digitalized. We've seen situations where there is an innovative product that is offered to customers, but you create a huge load of manual work in the background for reconciliation, because in the end, the transactions need to match what the fintech presents to you and what internally you see. So if you are not able to digitalize your internal process, then instead of having innovation with the fintech, you rather create a huge backload of manual operations that you will need to do in the background.
So, Jack, do you recognize some of this?
Very, very much so. And I think particularly I would pick up on the issue of pricing. I think in our experience, this has been one of the biggest lessons we've learned. And in some cases, we almost really had to look back, as already mentioned, to rethink about whether this partnership is viable. But again, it does work sometimes in both ways. So in one particular instances, when we started, first of all, working with a partnership to allow customers to receive money digitally, the cost was very high on the part of the clients, that the client were not very interested to use that as a channel. But what it did was it increased volumes of transaction for us because we could disburse a lot more loans than the manual way of our payment. So eventually we were able actually to offset some of the client cost because of the increased volume and revenue on our end. And we started carrying on some of that cost, which was from an institutional point of view, affordable. And that is how we've been able to, over time, reduce the cost that the client suffers. But also because we've now increased volume significantly, we now have a much more stronger voice to negotiate with our fintech partners, that we're now talking more on, bundled pricing than as it were to discuss pay individual transaction pricing. So pricing is very key, and I think it should be something that you're mindful when you go into these partnerships.
Damien, what are your reflections on that, kind of being on the other side of the table?
Yeah, so we are not doing transactional fee type of model because we are in the lending business. So one kind of model we have to solve part of the challenges that has been raised is to have a revenue sharing type of model. So when we launch, for instance, a new innovative credit product, we will be paid on the actual result of the product. So if we do not manage well the risk, we are not paid. So it's kind of a win-win situation. Nobody lose, or at least the MFI is not losing any type of money on the fintech side if the project is not successful. And us, we are incentives to do well. And I think that's how it should go. So if everybody has some sensitive to make the partnership successful. Of course, it will work better.
Yeah. I see we also got some mics here. I should have actually invited earlier, but I just wanted to quickly check in. Are there any burning questions from the audience before I wrap up? Please, I think this is the right moment to grab this microphone. Just looking around, I think everyone is still fine. Maria, I think just to kind of wrapping up this session, we've talked a lot about some of the key parameters, also some of the challenges you've been facing, particularly in kind of a lot of more hands-on kind of hand-holding work than you anticipated. Kind of what are the kind of key lessons learned that you want to bring forward also and that you will integrate in your business going forward in establishing partnerships and building out partnerships with MFIs and insurers on the other side?
So I think I will summarize it in one sentence,
short and sweet. I like it.
It's like Rome was not built in a couple of days. So I think our approach to building partnerships and what Damien was saying about trust is not built in 1 week. So I think our approach to partnerships is really like startup type, like agile, like let's start somewhere. Let's not try to build a perfect partnership, the perfect understanding, the perfect business model, because we will never work. Let's identify one opportunity. Let's see how we work together. Let's grow from this learning and then arrive to, a more structured thing, but don't try to structure at the beginning. So, and identify a champion that will, on the other side, help you arrive to this point. So I think for me, this Rome was not built in a couple of days. Start small, build and demonstrate, the win-win situation, and then scale. And if at this win-win situation is not working, you have not burned much at your end or at their end. Like, when someone comes and say API integration, the first meeting is like run because it's not going in the right direction. So I think it's start small, build from a good foundation, find the right counterparts, and also understand that MFIs or insurers are larger, so more complex in nature, and you need to find a good rhythm. But I think it's start somewhere and don't try to make the perfect business case, the perfect model in day one, because probably is unidentified.
Yeah. Faisal, any wise words? You're laughing.
Well, I would agree with that as well. Start small, and then you improve upon the business models. And also one thing to add is that fintechs like to see volumes. So the more volumes you have, the better your chances of negotiating a good price with them. Yeah.
Volumes, Jack. Do you agree?
100%. I think that conversations have become much easier as we have increased our volumes. But then again, we needed to start from somewhere. So we started when we had very, very few transactions. And then over time, we've been able to, I think it's a bit of a chicken and egg situation, because I think that technology has really allowed us to reach the volumes that we have. But with the volumes that we have now, we find conversations to be a little bit easier to have, even with the bigger fintechs. But to add to that, I would also want to say that it's very, very important that you put the customer at the center of the decisions. And whatever that fintech partnership that you seek to achieve, the client, the customer, the beneficiary should be at the center, because that informs a lot of the decisions that you make. What channels are we going to be using? In the case of Microloan, we still focus a lot on only using USSD. And therefore, when we seek partnership, we are looking for partnership that are very good in terms of USSD platforms, because that is where the client is. It also comes down to pricing. When you have the customer in mind, when you seek this partnership, you can, be able to know what is affordable and what is the right price that a customer can pay for the services that you are seeking to partner with a fintech. So I would add customer centricity in connections with the fintechs that we are seeking.
Your final reflections on this?
Don't forget.
Yeah,
our
no,
friend.
yeah, no, I'm not forgetting you. You're still there, Irene. We're not forgetting you.
Yeah, I don't have much to add. I agree with everything that has been said. I think, yeah, if I may add something, is that so the fintech industry has sometimes a bit scary. Also, you have, it's not the same fintech industry that you have in the US, Europe, Western countries, and what you have in Africa. I think as a fintech, if you want to be successful in more in the microfinance industry and that kind of area, you really need to understand the business. And I think us at Rubyx, we have a certain level of success because we came from that business. So the founding team of Rubyx was actually the innovation team of Baobab. And so we were there before, so we know exactly what you are looking for, what are the challenges. And so it's why we can help you tackle them. And I think most of them, all the fintech that are successful also have some kind of background knowledge in the industry that is very helpful to them to have some successful implementation.
Yeah. Irene, I'd like to close off with you. You're still with us, I see. I'm looking backwards again to see the screen. It's still a little bit awkward, but we can still see you clearly. Any last reflections awkward from your side?
Sure. I think my fellow panelists have said it all in terms of trust. I think that's a common thread that is coming through. And so I think one of the things I would say is a clear objective and need analysis is very important right from the onslaught. Clear set of roles and responsibilities for each person. And I think the panelist who just spoke last actually stole the thunder where he said about being customer centric. Remember, we are at the end of the day, the customer is the beneficiary and needs to remain on top. And so in all this, every party in the transaction will need their share, but we need to have a view of what's the end benefit for the farmer or the client in this case. I'm biased towards the farmer because that's our experience. Risk governance framework needs to be collaboratively worked out so that there are mitigating factors against each risk that is identified that actually enhances the trust level. And then also regulatory compliance, we cannot ignore that, especially in the insurance industry where it's highly regulated. I mean, right now we even have the data protection, which in the developing countries, I know we are playing a bit of catch up, but it is a very fundamental issue even in the way forward. So as we work with insurtechs, we are cognizant of that. I think just on the flip end, I know the challenges that we should be cognizant of is, for example, most of the insurtechs and fintechs are startups. And so one challenge we have seen is that when they're working with established financial institutions who at one point or another need to come into play, then there's an issue of how much they may fall short of expectations, not because they're not capable, but because they have got maybe not enough history to be able to line up their case. So, and I guess also it has taken patience. Some of the partnerships take quite a bit of time before we build that trust and get into some sign-ups. but it gets all worthwhile when you start seeing the volumes come through. So, and I think the last thing I would like to highlight is, as an insurer, we have seen quite a bit of challenge with our legacy systems, which is what we typically use for our underwriting, and how to connect that and integrate with the newer technology and construct APIs which can connect with the newer systems. So that's also been a bit of a hurdle to go through. It is working out, but it takes some time. And so I think those are the few highlights that I would give in terms of the working partnership.
Thanks a lot. And thank you to all the other panelists for sharing your interesting stories, experiences, and wishing you a lot of future fruitful partnerships. Thanks a lot.